This is the Mobile Home Park Lawyer Podcast with Ferd Neiman. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd Neiman.
Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode of the Mobile Home Park Lawyer Podcast. Got another great guest for you here today. We're gonna geek out on some tax stuff and some accounting and maybe some real estate stuff. We got a CPA here today. Please help me welcome my guest, Margaret Asher. Margaret, thanks for coming on.
Thanks, Ferd. And it is a pleasure to be here today on your podcast. I appreciate you having me on the show. And happy New Year to you and to everybody out there.
Yeah, likewise. Thank you. Well, tell us, I know a little bit more of your background than our average listener. So tell us your background and how you got into CPA world and how you really in particular, how you started getting into MH clients and stuff.
Sure. So I specialize in accounting tax services, specifically for clients in the real estate industry. I've got experience with both commercial and residential real estate clients. My client base includes developers, property owners, management companies, broker companies, and of course, investors. I am particularly passionate about the manufactured home industry and have been servicing clients in this space for over 15 years. I found this particular real estate niche extremely interesting because it affords some special tax saving opportunities, which make it a very attractive investment. So I started attending some MHI conferences to learn a little bit more about the space and about this real estate niche and its importance to the affordable housing problem that we as America face. I've had the special opportunity to work and consult with many young clients starting out as investors in mobile home parks and have seen them successfully grow their portfolio. I've also worked with those clients who have owned parks for decades and are now entering into the retirement phase of their life and having to navigate through those special challenges of selling and handing down their real estate investments to the next generation. So I really stress taking a proactive approach with our clients. I get involved from the very start, from structuring of entities, taking a look at operating agreements and purchase agreements, along with implementing tax strategies such as cost segs, 1031 exchanges, and opportunity zones. And then I'm there to the very end when they are ready to sell their property by taking a look at sales agreements to ensure that we are structuring it in the most tax advantageous manner. Also get involved on the accounting side to make sure that reporting is accurate and timely. Having clean, timely accounting records and projections are critical for our clients so that they have the tools and metrics they need to drive decision making.
Well, a lot to unpack there. Good stuff. We'll dive into several of those topics. One thing caught my ear is you mentioned how MH is good for tax savings or tax mitigation. Presumably you're talking about cost segregation study, accelerated depreciation. You want to maybe give us a little bit, or if not, tell me what else you're talking about. But that's the one that comes to mind for me. Maybe tell us why MH is better than say apartments, which I know it to be as it pertains to depreciation.
Yeah, so, depreciation allows us to write off the cost of the purchase of the property over its life while it is hopefully appreciating in value. So it's a very powerful thing used for our real estate investors. And cost segs take this one step further by allowing you to maximize this depreciation deduction. And as you may know, the cost segs are performed by engineers who go out to your property and they'll examine each element of the property to identify portions of the property that can be allocated into shorter depreciation lives and qualify for bonus depreciation. And so cost segs are extremely important to our mobile home communities because so much of the land can be allocated to land improvements and which qualify for bonus depreciation, which in 2024 is currently 60%, and then it's going to be reduced to 40% next year.
We're in next year now. We forgot. It's January.
Yes, I know,
I
I
did
know,
that
I
earlier.
know.
January 3 as we record. So. Well, and just to clarify too for others, I know you know this, with depreciation sometimes is called cost recovery. And then when she talks about class life, land improvements include things like the roads, common area roads, signage, fencing, and they can be deemed 15-year class life, and anything 15-year class life or lower number, like say 7 years, 5 years, can be bonus depreciated, meaning it can be written off on your tax return on day one. So you might lose $1 million on paper the day you buy the asset, but it's because of the classification, and it's a legitimate classification. The cost segregation study is the DD top defense to an audit under the IRS audit technique guides on depreciation. So it's a combination engineering firm, CPA firm that gives you this 200-page report, boilerplate mostly, but to break down the allocation of your purchase price. From a legal standpoint, it's nice when you're buying a property to leave yourself discretion. Like buyer has the right to allocate the purchase price, as opposed to the seller. Because if the seller says, no, it's all land, meaning dirt, well, you can't depreciate dirt, which means if the contract says it's all dirt and no other, then it's going to, tie your hands a little bit more when you come time to file your income tax returns.
Right. And so what's so unique about the mobile home park is that it's land and usually land improvements along with the homes that you might buy on it, which if they're not affixed to the land, qualify it also as personal property, 5-year property that you can bonus out to. It differs from our other type of residential commercial real estate in that, with those, you're buying a building. And so when a cost seg's done on those type of properties, the carve out of that personal property is a lot lower than with our mobile home parks. You may see a 20-25% carve out of personal property versus with a mobile home, you can see up to 60% in that land improvement bucket. So it becomes really, really impactful to our investors.
Yeah, they're great. The 60%, I mean, compared to say apartments are what, 35 or 40 maybe? Storage, maybe
That's on the
25 to
high side.
25 to 30.
Yeah, yeah.
Yeah, no,
So,
definitely.
and also the nice thing about cost segs is that they don't need to be performed in year one when you purchase the property. You can do a cost seg down the road or, catch up on, say you bought a park in 2020 and you didn't know you could do the cost seg or you just hadn't thought about that. You can go back and have the study done and then file a form, a change in accounting method, which is under Form 3115. And we catch up on all that depreciation that you would have claimed had you had the cost seg done in that original year of purchase. So
Now, in the event you do that in year
yep.
3, for example, do you go back and amend the returns for years 1 and 2, or do you just claim the depreciation on year 3?
We typically claim the depreciation in the current year that the
Okay.
cost seg's done. So it's a catch up. So you don't have to go back and amend returns, which
Which is a
can
pain.
be costly and
Yeah.
kind of a pain. So that whole adjustment that we compute is picked up as a deduction in that year that we do it.
Yeah, amending returns, I had to do it one time. My CPA missed something. So luckily they did it at no cost to me because they had to go back and fix something. But I had investors. So I had to give all my investors updated K1s So they had to go amend their personal returns. So they were not pleased with me, um, because my CPA may have missed something significant. So
And the
anyway,
other problem with that is under new rules, you might not be able to amend and you have to file, an audit adjustment.
right.
And so those rules have become very complex, to navigate through. So it's much easier to just do that.
I
Uh,
think that is you can only amend if you've filed an extension. So what my CPA does is he files an extension on everything, even if it's like on day one, and then even if we get it done before ready for April 15th, he already had an extended and he'll file on April 16th. Because it gives
yeah,
you the ability to amend later in life if you need to.
yeah, or
Instead of
file a
the
superseded return.
yeah,
Correct.
that's
Yeah,
yeah, that's
yeah,
determined. So let's talk about cost recovery recapture.
yeah, yeah.
So when you sell the property, how does that work? And when and where I'm and what a lot of people mess up, in my opinion, is a true understanding of how the sale works, and even in a 1031, because you got different components of what section 1245 and section 1250 property, and how that works, and then the equity piece and the debt piece, and then avoiding things like boot. And this is where we can really geek out, and half our listeners are turning us off. But for those that aren't,
Right.
let's give them some gold here and explain to them how the fatal flaws or lessons learned that you've seen people do that they don't understand.
Yeah, depreciation is great. Bonus depreciation is wonderful, but it's really just deferring tax. So you're getting the cost benefit tax savings, but it does catch up to you when you go to sell the property. So what happens is that you have to then recapture the depreciation that you've claimed in previous years. And so, like you mentioned, 1245 property, which is our personal property, which in the mobile home community, that bulk is going to be in land improvements and our homes, that's going to be recaptured at ordinary tax rates. Now, that rate depends on your individual tax bracket, but it can go as high as 37% if you're in the highest tax bracket versus now our 1250 or real property, which is our buildings, that's recaptured. The depreciation component is recaptured at 25% tax rates. And then we have our 1231 property, which includes land, and that is going to get your capital gains tax rate, which is typically 20%. So now you're just recapturing the depreciation at those rates. So it's not like the whole gain is taxed at that. And so if I can take you kind of through an example, it might be easier to
Sure.
kind of see what we're talking about. So let's say that you go out, you buy a piece of property for $1 million. You take depreciation of 200,000 on it, and that's going to leave you with an adjusted basis of 800,000. Now, your gain is computed on the sales less your adjusted basis. So now let's say we sell that property for $2 million. So we have a $2 million sales price, adjusted basis of 800,000, giving us a total gain of 1.2 million. So now we have to take that 1.2 and we have to say how much is taxed at what rates. And again, ordinary 25% recapture or 20% capital gains. So let's say that that depreciation we've taken over the years applies to land improvements. And the land improvements is going to get recaptured at ordinary rates. So that 200,000 of the million two gain gets taxed at those ordinary rates, and then the remainder gets taxed at capital gain rates. So obviously, when you're selling, you want to take advantage of allocating a lower amount to that personal property value versus possibly your land value or your building.
So if that was me and I'm selling that for $2 million, my true profit's 1 million because I bought it for 1 million. My
Yep.
taxable gain is 1.2 because I wrote off 200 in the beginning. So if I was to structure my purchase and sales agreement, is it in my best interest then to negotiate with the buyer and say, hey, I want to allocate only 200,000 to land improvements, and I want to which means which is the same amount that I wrote off, but the extra million I want to allocate into dirt, or just land, because then dirt is going to be taxed at capital gains rate, which is max at 20, as opposed to ordinary, which is max at like what, 37 or 39.
Exactly. That's exactly right. Now you're going to face that the seller wants just the opposite,
Right.
right? They're going to want to get as much personal property value as possible, because if they want to take advantage of bonus depreciation, they
Right.
may.
So sometimes we see people butt heads on this, or a lot of time. So and there's a form, I forgot what it is, 8491 or something, 8451 or something, where both parties are supposed to fill it out for the IRS and say, here's the true allocation. But that doesn't happen very often. I almost never see that happen, where the
Yeah,
parties actually
yeah,
fill out that form. So what if the contract says, I'm the seller, you're the buyer, we couldn't agree on the allocation, both parties can allocate however they want? What happens then? Is that just an audit risk for one of
exactly.
us?
Yep, yep.
Because I'm going to
And
claim it as what I want, and you're claiming what you want. And if the IRS sees it's the same piece of real estate, they may ding one of us or both of us.
right, right. So if you cannot agree, the best thing is to kind of lump it all together, make your own determinations, and then, go with that risk.
Now, what about, so that's section 1245 and section what, 1250 or 31. What about if I'm the seller, I just did a good job, I'm selling my property for 2 million, $1 million profit, 1.2 million taxable gain. What if I 1031? How do I 1031
Yep.
perfectly to pay zero tax?
Yeah, so 1031 allows us to defer the capital gains on the sale of a property. And again, it's got to be for like or similar type real property. So it cannot be personal property. And so sometimes people get caught up in, like, they think they can go out and exchange into another partnership interest and buy into the partnership. That doesn't qualify. So you have to actually buy land, or real property, I should say. And so you have to hire a qualified intermediary prior to the sale of your property. And upon closing, those proceeds go over to the intermediary, who holds on to those until the replacement property is purchased. So the taxpayer cannot, have possession of those funds at any time, or they risk blowing the exchange. And then we've got 45 days to identify up to 3 properties, and then 180 days to then actually purchase that property. Now, in order to avoid any kind of boot, which is going to be non-like kind property received in the exchange, you need to trade up in fair market value and equity. So a couple examples, um, of boot that can happen is if you take cash out of the sale. So that's kind of a easy one to kind of identify. It
So
also,
let me slow down for a second so we can
sure.
put some numbers to it. So I bought the original property for $1 million. I put 250,000 down. So I had 250 of cash and I got 750 of debt. When I sold it, I sold for 2 million. I only have 250 of original cash, but I sold for 2 million. So in order to avoid boot at the beginning, I got to buy something at least 2 million,
Yeah,
correct? And I got to have at
correct.
least 250 cash in.
Right.
So if I go buy a $3 million property and I get a really favorable lender and I get a 100% loan, well, even though it's 3 million, I take the 250 out, I'm getting boot taxable on the 250. So if I'm buying a $3 million property, even if I had the opportunity to get a 100% loan, let's say I bought like a Walmart, triple net with Walmart credit, the bank may give me a full 100% loan because Walmart's always going to pay. But it's in my interest from a tax standpoint to just say, no, I don't want the full 100% loan. I want to put 250 towards it so I don't pay tax on the 250.
Yeah, exactly. Because now you're not trading up in equity.
Right. Okay, so that's
So,
the easy boot to figure out, like, hey, don't take your money out for
right,
the
right,
harder
right.
one is what we're going to cover next.
The harder one, and that trips up people, is in your closing statement, you typically are going to have some kind of prorations, right? You're going to have prorations for property taxes, rent, maybe prepayment penalties. So that's can be a potentially very big number that will hit your closing statement. And those items are not considered exchange items. And all those, if you don't replace those in additional cash, those are going to trigger boot or trigger your capital gain. Now, on the flip side, it's not all bad, because those expenses that you're paying out of the closing can be used as ordinary expenses on your return. So,
Okay, what about back to my $1 million example?
yeah,
I put 250,000 down. My tax basis is 800,000 because I took a $200,000 write-off for the land improvements. When I 1031 into a Walgreens, what other problems can I have because I got some 200 of improvements and 800 of dirt? Do I have to buy a Walgreens that has an 800 and 200, or can I just buy a Walgreens that has like 100,000 of dirt and $900,000 of building?
yeah. I mean, again, it just has to be like property, real property. So you can exchange into commercial versus residential versus raw land. So that allocation doesn't matter.
Well,
But
what about the 1245 land improvements? I thought you told me that was personal property.
yes, and as long as the personal property is under a certain threshold, it will not, it'll be fine for your
So I
exchange.
can still 1031 that as real property. We just
Correct.
call it
Yeah.
personal property, but it's still real property. I don't have to go buy like baseball cards in addition to the
Correct.
bill.
Yeah, yeah,
And you can't 1031 personal property in real the actual real personal property. Like if I
correct.
bought this office building and my desk came with it, that's not real property. So I can't 1031 my desk.
Exactly. Yeah,
But I could 1031 the electrical if I cost segged it into the components of the electrical.
correct.
I called it personal in order to write it off, but when I sell it becomes real again, or at least for 1031 purposes.
Yes, exactly. Yeah,
Yeah, to me, that whole series of concepts is one of the more complicated pieces of these that you just want to make sure you get them all right when you're on your
yeah.
exit. Okay.
And then any type of gain that you defer goes to reduce then the basis in the replacement property.
Okay.
So it does, once you sell the replacement property, obviously it does catch up to you. Because
Yeah,
then
the goal would be
you're
is
gonna be,
you sell replacement property, you 1031 again, you do it forever, and then you die, and then
right.
it goes to your kids.
And
Yeah.
they get the step up value
You can
and,
step up in basis, and so long as your estate is not worth, I don't know what the limit is now, 13 or 14 million, it's a pretty big number
yeah,
with estate exemption. Um, and that number changes quite frequently with politics in the last 20 years. I remember
yeah, that's for
when
sure.
George Steinbrenner died, he owned the New York Yankees. He was a billionaire. I don't know if they pulled the plug on him, but it was like if he dies in the next 3 weeks, there was an unlimited estate exemption, and his kids are going to get the Yankees with no gain. But if he dies after New Year's Day, the exemption is 4 million, and they lowered it, and everything above 4 million, they're going to pay tax on. So it was like a big deal, and it's been less volatile, in the last 20 years, been more consistent than it was around that time, which I think was like early 2000s. But
Yeah. So
one other thing,
something that we do come across quite frequently in partnerships is that some of the partners, when you go to sell your property, some may want to cash out and others may want to do a 1031 exchange. And because it's the partnership that holds the property, they're doing the 1031 exchange. And so you can't have some partners do it, some partners not do it. So a strategy we sometimes see is called a drop and swap, in which the property is distributed out to the partners. So now they own a tenants in common interest or a TIC interest, and can do whatever they want to on the individual level. So some can then sell it, cash out. Some can then do a 1031 exchange. IRS it is challenged by the IRS because they like to see, a 2-year hold. So when property's distributed out, to be on the safe side, we recommend holding that property before you go then and sell it. Because otherwise the intent doesn't look like you were intending to hold the property.
But
It's,
nobody does that. Nobody does that in real
I
life.
know, I,
Because you can't, because it's a loan covenant violation to take the
yeah,
one LLC, you say partnership, because that's how it's taxed, but I always think a legal LLC is how people mostly hold real estate, and then it goes from one into 5 ticks, and in order your lender, your existing lender doesn't like that.
yeah,
So in order to do it, what do you need to do? You do it the morning of closing with the lender's wink wink blessing, and then they split it up, and then they immediately sell. And then if the IRS were to audit it, they're going to say, well, you didn't intend to distribute it out to hold it for 2 years. In fact, you did it the morning of the sale. So I mean, I looked at it as a QI. We did it from the law as a law firm. We've done that over several clients, and the one QI in particular I thought was extremely sharp. I don't have him on here now that I talk about him. Make a note of that. But what he said was the IRS has only investigated this on audit like twice, and they don't go after little fish. They go after the biggest fish, and the biggest fish has 100 lawyers and CPAs, and they beat the IRS. So the IRS kind of quit going after them and just like whatever. But then the state of California is like, well, we want to do it for state tax. So this guy was a California's QI, and he said, and he's a lawyer. He said, if the owner is a California resident, high risk of getting in trouble. New York, medium risk. Everywhere else, yeah, do what you want. That was kind of his off the record
his
advice.
take on it.
Yeah.
I mean, it is, we advise clients on the risk and we weigh it, if you have a better fact pattern, that's great. If you can straddle, between tax years, between distributing out the property and then selling it, that, that looks a little bit better too, so.
Yeah, I've done one of those actually too. So straddling, what you mean by that is for the audience is like I sold the property on 12/28, ticked it out, me and the LPs. The LPs we 1031 into department deal on 12/30. And then the other GP ticks we put into a QI, and we bought another property uh, in the next town in February, different tax year. So we didn't hold it for 2 full years, but we held it in 2 different tax years.
Yeah, yeah,
It
so.
happened to be 60 days.
So yeah, we kind of recommend that if possible.
Okay.
So,
All right. So we've covered tick. We've covered the 1031, bonus depreciation, the 1245s and the 1250s. What is another tax thing that people get tripped up on about? I mean, maybe we want to talk about who gets to 704, or we want to talk about who gets to write off. If I'm not a guarantor on the loan, do I get to take depreciation?
okay, so that kind of gets into partnership law, partnership agreements. The partnership agreement is really going to dictate how we are going to allocate items of income, deductions, gains, and losses among our partners, along with how the duties of the different partners are going to work. Partnerships afford the greatest flexibility to business owners to kind of craft their idea of how they want to structure the economics of the deal. It under 704, it must have substantial economic effect, which means you can't just say, hey, I'm going to allocate losses to this passive investor because they need it. You've got to have a reason of why you're allocating things. And so like I said, the partnership agreement has a lot of tax words in there. So we take a look at those partnership agreements, make sure that, our clients understand what they are, dictating in that partnership agreement and how it all, has tax effect. And so when you were talking about depreciation and losses, the first thing there are loss limitations at the individual level. So in a partnership, everything flows through to the individual. And at the individual level, you have to meet certain tests in order to actually take that loss. Now, that loss is going to include that depreciation deduction. And so, the first hurdle is having basis. So you've got to have basis in your partnership interest in order to take a loss. And basis is going to be, your capital contribution, less any distributions, plus or minus any income or losses you've taken in the year. So
In capital contribution, you mean writing a check, not sweat equity.
exactly. Yeah. And so the other thing that gives you basis or the ability to take losses is allocation of debt. Allocation of debt becomes super important in our partnership area. And so it gives you basis to take losses.
Because you have at-risk capital, right? Meaning,
Well,
if I don't pay the mortgage, I'm gonna lose my house. If I don't pay the mortgage on my mobile home park, I'm gonna lose my house, because if I signed a personal guarantee, so even though I didn't put any cash in the deal as a GP, I get basis because I signed a note.
yeah, and there's different types of liabilities in a partnership. You have your non-recourse, your payables, your accruals, and then you've got your qualified non-recourse debt, which is your mortgage. And then you've got recourse debt, which is gonna, if somebody guarantees, one of the partners personally guarantees the loan. Now, the qualified non-recourse debt and the recourse debt are going to give you at-risk basis. So a little bit different than basis, because basis includes non-recourse debt. At-risk basis allows you then to take the losses. So what becomes very important is that allocation of debt. And if you've got partners that guarantee the loan, they are going to get allocated all that recourse debt. So, where if it's a straight mortgage and all the partners are, involved in it, they're going to get their pro rata share. And so now they've got, additional at-risk basis to take additional losses. But if we've got one or two partners guaranteeing it, all of a sudden they don't get any of that qualified non-recourse debt, and it becomes all recourse debt. So now those partners are able to take losses to the extent of, not only their capital contribution, but their recourse debt.
Right.
And it becomes really powerful, especially when you're generating these large depreciation deductions. If you're doing a whole lot of improvements on the park, because you may be taking out additional financing. And, so not only are you taking out additional financing, you're also getting the depreciation deduction. And it could be allocated just to those, particular partners on the hook for it.
Yeah, I'm gonna put a number to this too. So back on our example, you know, me and John Smith bought the $1 million property with $250,000 down. If if John put up the 250, but I signed the 750 loan, we both have capital. He has cash. I have at-risk capital on the personal guarantee on the recourse loan. We took a $200,000 loss on the write-off through our cost segregation study. If we bought that property on New Year's Eve, we only owned it for 1 day. If it was a $1 million property at a 10 cap, it has $100,000 of NOI, which is, basically 2,000 a week. So in 1 day, we made less than $1,000 plus or minus. Let's call it $300. We made $300 of actual revenue or net revenue, so taxable income for this calendar year. But because we bought it on New Year's Eve, we get $300 minus 200K that we both get a piece of, depending on how we allocate it in the operating agreement. But it's going to be way more of a loss on paper than the $300 we made. So it's going to be negative $199,700 of loss or negative income, which means if I made $100,000 this year practicing law part-time, all of my law that would have otherwise been taxable goes down to zero, because then I'm a real estate professional. So my minus 199 burned through all of my $100,000 of taxable law income. So net is I made $0 this year, which means I paid $0 in federal income taxes. and if um, and it's totally legal.
Yep. Yep. And, where we also see this is with, brokers. They're making lots of money brokering different deals, and they also own parks. So all those losses, they're owning and managing. And so those losses from the parks are offsetting that commission that they're earning on the broker side.
Yeah. So the only downside is when you eventually sell the park, you got that recapture. And if I sold
Yeah.
the park for 2 million, I got to pay gain on the million of profit, but I also got to pay gain on the 200,000 that I previously wrote off.
Right.
And then
And you
obviously
also,
I'm doing both at the same count, same day, same year. So it's all of a sudden it's a huge number. So you're in max tax brackets.
yeah, and you also have to be careful, because if you go out and you refinance, and all of a sudden now, the park is stabilized, you go out, refinance, and those guarantees get taken off, you can run the risk of then having to recapture some of those losses if the qualified Q&R debt isn't enough to cover the losses that you've taken. So you have to kind of be careful there.
Yeah. Interesting. Well, Margaret, this is great. In the interest of time, I want to keep moving here because this has been good. A lot of information, a lot of technical for people. Any other kind of tips or tricks or last minute ideas? And then if not, where can people find you after this episode?
Yeah, so just kind of want to go through some of the possible tax impacts with the new administration coming up. I'm sure that people are very curious to know what's going on, and what we can expect to see in 2025. So bonus depreciation is one of the real important things that we're watching. President-elect Trump has said that he permanently wants to restore the 100% bonus depreciation provisions, which is great news for our clients. Qualified opportunity zones. Trump's first administration created these QOZs to promote investment in economic distressed areas by offering tax incentives. The second Trump administration has said that they want to extend the program and provide additional benefits. And that program has really had some tremendous positive impact. So we're hoping
And
that
in
goes.
in highly distressed census tracts, meaning poor areas of the country where nobody otherwise typically has invested, there's now a
Yeah,
tax benefit to investing.
right,
So if you didn't love Trump already, you should, at least from a tax perspective.
definitely. And then two other things that we're looking at is the 199A pass-through deduction, which also known as the QBI, Qualified Business Income Deduction, which allows taxpayers to deduct up to 20% of income earned through sole proprietorships, partnerships, and S corp businesses. So this deduction is supposed to phase out at the end of the year. We're hoping that it gets reinstated. Trump has, shown that he wants to reinstate that, along with the 30% interest limitation. So with TCJA, there was a limitation of 30% of adjusted taxable income to taxpayers. The adjusted taxable income previously accounted for depreciation and amortization. Those were add backs. And then the past couple of years, they took that back. So now that adjusted taxable income base is a little bit is lower, and our interest limitation is higher. So he is advocating to bring back that depreciation and amortization add back.
Nice. Well, I'm excited about it. This is great stuff, Margaret. Really appreciate
Yeah,
it. How can people reach you after this episode?
yeah.
Phone, email,
So
what's the best?
email is great. Margaret at djeadvisors.com. You can also reach out to me on LinkedIn. So yeah, I'd love to hear from you.
All
And thank
right.
you again, Ferd. I appreciate.
You got it. Take care, Margaret.
All right.
Bye.
Thanks.
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.